It's particularly important, of course, for a market like gold. Not talking about gold, but as a market like gold, because gold has a big influence on other markets as well as being a key outside market for other markets. So it's a good one to look at overall perspective on markets. The price data that is used in Vantage Point indicators comes from typical prices for the most part. A typical price is the average of the high, the low, and the close. As you know, most analytical software uses only the close, but computer analysis has determined that typical prices are more useful for forecast because they take into account the whole range of price action for each day and not just that one price. By looking at the intermarket analysis aspects of it, looking at typical prices, Vantage Point makes some short-term market forecast that can be useful for the intraday trader as well. So let's start looking at some of the charts and see what we can come into here and find as a trading strategy that we're going to develop. Now, I want to say first of all that the trading strategy that I want to talk about a little bit is not really a refined, defined strategy. I'm going to be looking at kind of a concept when I'm talking about some of these strategies, because it's something that's an ongoing, evergreen type of process. You keep working at it and try to improve it. See here the 1 year chart. We're going to cut down the time frame on this in the first place because we only need, let's say, 6 months worth of chart to kind of explain some of the basic parameters or indicators that we're going to be using here. When we are looking at the chart, we have in Vantage Point, we kind of have a cast of characters that we're going to call out here and show you a little bit about what they do, what to expect for them before we go to a chart, and show you how they apply to a chart specifically. The first thing that we want to look at is the overall appearance of the chart and what it looks like, what kind of signals we have. Obviously, we know that gold has been kind of in a long-term uptrend for quite a while. It would take quite a turn to actually put it into a downturn, but it is in a long-term uptrend. So you look at things like this top right here, this doji top. That's a candle signal that you're going to kind of look at. You're going to look at bullish engulfing patterns, bearish engulfing patterns, those types of things, previous highs, previous lows, main trends. All of that comes into it because it's what other traders are looking at. The traditional technical analysis are looking at those kind of charts, and that's why everybody that is trading should be aware of what they are looking at. To that, we're going to add some indicators from Vantage Point. We're going to start with the medium-term crossover indicator. The medium-term crossover indicator is simply a predicted moving average, which is that blue line that you see there. And the actual moving average is the black line that you see there. That's a simple moving average of the close. The predicted moving average is the shorter term moving average of the typical price. So that's one of the things that we're going to be looking at, and we're going to rate it when we get to our intraday strategy as an angle upward, means like a +1 if we want to keep a scorecard on it, and an angle downward would be a -1 or a short clue that we might have. We also have in several places here, we have the crossover clues. That's kind of a bonus point. You might want to add another point if that crossover occurs, because that means more strength that is going down to the downside. Also, it's crossover occurs. We're going to be looking at that angle, number one, then we're going to add some other indicators, and we're going to be talking a little bit about another indicator that I think is kind of a unique proprietary indicator for Vantage Point, and that is the predicted neural index. That's that gray line that you see on the bottom there. In this case, what this is, the neural index is a comparison of two 3-day moving averages, a predicted moving average and an actual moving average. And what it tells you is that if the close, or if the typical prices will be up in 2 days, then you have a 1 reading. If the typical price will be down in 2 days from what it is today, then you have a 0 reading. So these are, there's no in between. It's either a 1 or it's a 0. So obviously if it's a 1, that's more of a bullish indication. Put that point on the long side, or if it's at 0, it's a short indication. Probably the easiest one to grade in terms of what kind of a score you want to put on it. Going to add more indicators. We're just kind of adding this in, then we're going to flip over here in a little bit and talk about them in an analysis standpoint on a short-term trading strategy. The next one that we are adding on the bottom is the predicted differences. You have the blue line, that's the predicted medium-term difference. The green line is the predicted long-term difference, and the difference is between a predicted moving average and an actual moving average. As you can see, they tend to swing up and down. Quite often that swing will occur and the crossover will occur even before the crossover in the moving average occurs on the actual price chart. Before that trend gets underway, you kind of have an alert that something is underway. It acts as a momentum indicator, and it is important to know again here what the angle of it is. If it's pointed up, obviously that's a bullish sign. Pointed down, it's a bearish sign. When we say bullish or bearish, the reason that's important is because we're going to look at the evidence that we get from these predictive indicators to determine which way we're going to trade during a trading day as an intraday basis. We're going to add a couple of more. I know we're putting a lot of lines on here, hopefully not confusing anybody too much, but we'll explain them as we go along here. The next one we're adding is a predicted high and a predicted low. The predicted high is the projection for what the high will be the next day. That's that gold line that you see there, or orange line. The predicted low is that pink line that you see. That's the predicted low for the next day. That forms a channel, and again, we have some indicators that we can use here on a short-term basis to indicate position, places to place a position based upon the other evidence that we get from our indicators. We have a lot of data here, so we're going to cut back this time all the way down. Well, let's do first, we'll cut back down to 2 months just to kind of show you one other point about this. You'll notice at the far right-hand side of the screen that when I put my cursor right here, and you'll see where it lines up, that all the other data, like the predicted moving average, actual moving average, predicted differences, and Euro index, stops there. But the one that goes ahead, that moves ahead and gives a projection for the next day, is the predicted high and the predicted low, which is important in terms of providing a potential